So Microsoft will invest another $7.5 million to build out AI infrastructure in Canada. Let's start there with Jack Manley, global market strategist for JP Morgan Asset Management. Thanks for joining us today.
Yeah, of course. It's great to be here. Thank you.
So Microsoft has made a few of these announcements recently around the world. Does it make strategic sense to make this kind of investment in Canada on their end?
I think it does make strategic sense on Microsoft's part. I think it's also good news for the broader Canadian equity market, broader Canadian economy. You know, when we have conversations about technological revolutions like the ones that perhaps we are in right now, the way we typically see market leadership evolve over these revolutions is it moves from what's referred to as the makers, the guys that are actually building the infrastructure, to what's referred to as the takers, the guys that are using that infrastructure to revolutionize whatever particular business model they may be pursuing. We're very clearly in that maker phase. What we don't talk a lot about is the taker phase. And by building out more of this infrastructure in countries like Canada, you are giving Canadian enterprises the opportunity to become that next big taker. A lot of benefits from AI without necessarily the enormous amount of capex that companies in the Magnificent Seven, those hyperscalers in particular, have had to pump into this story. So I would say good news.
Okay, so let's talk about a couple of things, because Canada is looking for control over its own data. It looks like this will help along those lines. But at the heart, you have a company that is based somewhere else. So will it truly give Canada control over its data?
I can't speak to whether or not it gives Canada control over its data. That I don't have enough insight into to be able to speak to it authoritatively. But I do think that allowing Canada to increase its adoption of artificial intelligence, right now, latest I saw says that it ranks somewhere within the top 20, but it's not within the top 10. That I think would be overall good news from an economic perspective, especially when you're talking about an economy that's been somewhat sluggish and looks set to continue to be sluggish as we move through 26.
Okay. As you, I'm sure, have heard, Donald Trump now says it's okay for NVIDIA to sell those H200 chips to China. What changed?
Yeah, well, so, when I think about what's going on geopolitically, especially as it relates to tariffs, very clearly China and the U.S. are engaged in a 21st century space race, right? When you look at what the U.S. has to offer, the United States has a lock on the highest quality, highest technology semiconductors in the business. When you look at what China has to offer, they have a lock on the world's supply of rare earth materials, which are going to be critical for building out a lot of technology infrastructure, those chips included. We see that each country wants what the other guy has, right? And what we've seen recently is that China has been using access to rare earth minerals as a bargaining chip for this trade war that the United States is waging with them, and in trying to leverage greater access to these high technology, high capacity semiconductors. To me, this feels like the next step in a broader negotiation where the United States is offering high quality chips, not the highest quality chips, but high quality chips, almost an olive branch, saying, okay, we gave you this, now you give us something in return. Let's not ratchet up these tensions any further, spook markets. That's how I'd interpret it.
Does it, however, put the U.S. at risk in the AI race?
I don't think so, at least not giving these chips to China. The bigger risk in the AI race is that China is able to develop their own technology homegrown. As of right now, it's not there, but very clearly they are looking for it. And if you remember earlier this year, DeepSeek, huge headline, Chinese artificial intelligence company announcing that it was able to build large language models with similar complexity and capacity to their U.S. counterparts, but not using U.S.-made chips, and frankly, doing it for a whole lot less money. Remember, it sent jitters through markets. It was a broadside against technology names, major pullback at the start of the year. We might see something like that happen in 2026 if China were to announce another breakthrough on the AI front as it relates, again, to their homegrown capabilities of building out those highest quality chips.
All right. Talk to me about how you expect the markets to end the year.
Yes, I'm reasonably confident as to where this market goes. When it comes to the United States, we are a hair's breadth away from 7,000 on the S&P, and barring any big surprises, and one of those big surprises could be tomorrow with the Fed's meeting, but I'm not looking for it. barring any big surprises, I see no reason why this market can continue to melt higher and hit that 7,000 target by year end. When I think about 2026, though, what worries me a little bit is that even if the market does get up to 7,000, entirely possible, there is still a deep concentration problem with the Magnificent Seven accounting for the lion's share of those returns and a very significant valuation problem. These markets are trading at levels we haven't seen since .com. I don't think it's a bubble, Morella. I wouldn't go that far as to call this a bubble, but I do think you still have a market that next year will be susceptible to some of these shocks, like those headlines like DeepSeek that I mentioned earlier. So, yeah, we grind higher. I think I'm constructive on where the market's going through the end of the year. I'm frankly even constructive on where we go next year, but it's not going to be a smooth journey. There will be a lot of bumps along the way.
Okay, so many people have had concerns about valuations. Are you moving towards stocks with lower valuations at this point?
I'm not overtly concerned with valuations. You know, when I think about why you're buying the Magnificent Seven, nobody is buying these names, or really any name that is tied to the AI revolution, for the earnings that they're going to kick out over the next 12 months, for the dividends that they might be paying over the next 4 quarters. That's not why you own these companies. You own these companies because you expect they're going from $5 trillion in market capitalization to $10 trillion in market capitalization over the next several years, and it's going to make you a lot of money along the way. Looking at forward price to earnings ratios, where those earnings are next 12-month metrics, it doesn't tell you the whole story. So to me, valuations are important. It's not the be-all, end-all when it comes to investing in technology, artificial intelligence in particular. That said, there are a lot of names out there that are going to be trading at much more reasonable valuations, sectors that will be trading at much more reasonable valuations, things like financials, perhaps materials, industrials to some extent. All of these could present interesting opportunities in 2026 for those investors that are looking to diversify away beyond just the Mag 7 and own a little bit more of a U.S. equity market where we're expecting to see earnings growth participation broaden out.
All right, Jack Manley, got to leave it there, sir. Thanks for your time. Jack is global market strategist, JP Morgan Asset Management.